So welcome back, guys. We are going to be learning chapter 11, which is going to be depreciation. This is by far one of my favorite chapters, personally, because it's cool. What you need to do is you need to remember the formulas, and that's the hard part. Is if you had trouble memorizing formulas, then this is not the chapter for you. But great news! I created a review sheet that has all the formulas on there for you. So all you need to do is print out that review sheet and you can use it on the exam. Okay? So you have the answers there. Okay? So again, we're going to talk about depreciation.
It's real easy.
It should be easy. Okay? All right. So we're going to talk about depreciation. We're going to look into the first depreciation method called units of production. But first, before I even introduce that, what is depreciation? Well, depreciation, right? When you purchase fixed assets, right? Eventually they become obsolete or they become old, right? Over the period of time. Like you may have bought a brand new machine back in 2010 and knowing how technology works, do you think 10 years from now, is it going to be up to its prime?
Nope.
No, it gets used. The technology gets outdated, right? There's going to be new, faster processors out there that are way much better in the future, right? And on top of that, right? Your asset's going to lose its value over time. Right? If you purchased this machine 10 years ago, do you think 10 years from now you can sell it for the same exact price?
No.
No, of course not. So this is what we need to do. This is what depreciation means. Okay, so the purpose of depreciation is to spread out the cost evenly, or maybe not evenly, but spread the cost out of the asset over time. Okay? So then when you are utilizing the machine and you're actually making it work, it's not going to be the same value as it is when you purchased it, right? It's going to be wear and tear is what they call it, right? So yes, so it's also spreading out the revenues and amongst, so it's spreading the cost amongst on the products and to match your revenues, okay? So that is what depreciation is. So again, key term here is going to be fixed assets, okay? Fixed assets, you're going to be using depreciation, all right? It will make sense when we move down to amortization, okay? So what are examples of some fixed assets here that apply to depreciation? So anything that has a useful life, okay? So example, fixed asset. What are the three things that fall under the categories of fixed asset?
Property,
Property, place, and plant.
Property, plant, and equipment. Okay? So property, right? The parking lot, right? The land that has your building on top of, right? Except for land cannot be depreciated. It's the only one that you cannot depreciate. Why? There is a different terminology to this. And remember, land doesn't matter when you purchase it, it will never go up in value, okay? It can lose its value, yes. But you know how they always say when you're doing property management, right? Oh, this land is I purchased it for $10, now it's worth $100,000. No. In accounting, it does not work that way. The way you bought it, if you bought it for $10, it's still going to be $10. Unless you sell it and you have to recognize the gain, then yes, that's how you would recognize it. But for this fixed asset, land is the only one that cannot be depreciated. There's actually a different terminology for it. It's called depletion. Okay? But for this class, because this is whatchamacallit, accounting 101, you actually learn about depletion later on when you become more advanced into accounting, and this applies to also real estate as well. Okay, but for this class, I'm not going to have you understand land. Okay. So for the other types of assets, right, over a period of time, there, here's some examples. Okay, computers, definitely computers is going to be considered as an electronic, right? It's an equipment, it's a machinery, right? You got furniture. Furniture is your property, right? It's definitely got a life to it, and we'll talk about that. What kind of life it has for that. But furniture, it does, again, it can wear and tear. If you sit on it too much, the pillows can get lumpy. It's not going to be the same. And on top of that, not many people would want to buy a used furniture unless they need it, right? And a truck. Truck is obvious. It's a vehicle, right? It's an equipment that you use to carry your stuff, right? And then plant is obviously a building, right? Building,
Yes.
the parking lot. So those are very significant examples of what they are. So anything that ties under a fixed asset, you are going to consider it can be depreciated. Okay.
Okay.
So here are the rules for GAAP and why we need to use depreciation, okay? So first off, the number one rule is we're talking about historical cost, right? Okay, so historical cost is going to be what the value of the asset is, correct? You're going to record it the day that you purchased it for, okay? So that's number one. Number two is going to be the matching principle, okay? So again, when we depreciate it, you need to have equal and not less, okay? It has to be equal to the amount that you costed out to be. Like, so your historical cost must match your depreciation, okay? They have to match because you are, in other words, you're giving your asset less value. And how are you doing that? You're expensing it throughout the entire usage of its life. Okay, so the two important rules that govern depreciation will be historical cost and matching principle. Okay. Now, there are 5 components when we're dealing with depreciation, okay? You need to have first, number 1, what is the cost of the asset, okay? And each one, I will go into detail of exactly what each consists of. Number 2 is either the estimated useful life or the estimated use of production, okay? All right. Third, you need to determine, is there a salvage value? Another term for salvage value is residual value. Okay. Fourth is going to be the date that you put it into service. Okay, that's very, very important that you understand this one. The date matters when you are putting the asset into service. Okay, and then lastly, what depreciation method you are using. Okay. So let's go ahead and move on to the first one. The first one's going to be cost of the asset, right? You need to determine the full cost of the entire asset, right? So that can include the selling price, sales tax if you had to pay it, any shipping and handling fees that had to accommodate it, right? If there's any product fees, so let's say you purchased a warranty on it, that is included into the price of the asset, right? Anything that you need to put, if you need to train people how to use the asset, that is also considered an expense that goes towards the cost of the asset. Okay, and then lastly, installation. So if it requires you to have some kind of installation, whether it's a fee, you need someone to pay to install it, or you need to have a foundation to install it, then that is going to be considered as part of the asset. Okay, so all of that is included. So don't forget, when you're dealing with the cost of the asset, there is more than just the selling price. Okay. Okay.
Okay.
Okay, so all right, oopsies. Yeah, next section is going to be estimated useful life and salvage value. I pieced these two together because they kind of go hand in hand together, okay? Now, there are two ways you can determine the estimated life and the salvage value, okay? If you were to go with gap, okay? So there's the two ways, right? There's gap and there's what we can do as a sole proprietor. Okay, sole proprietors have leniency, but they also have an advantage to determine these two components, right? They have the advantage to give an estimated life as well as determine a salvage value. However, okay, if we go follow the rules of gap, okay, estimated life is usually given to you. Okay? So, in other words, assets already have a determined life value to it. Okay? And it's based on the type of asset it is. Okay? So, in other words, Gap has a similar Blue Kelly book, right? You know how Blue Kelly book is for vehicles, right? Same
Yes.
thing. Gap has a book for all of the assets that you can list out there, and they have a pre-existing or determined useful life. Like basically, this is like an average that people suggest usually happens. Okay, so for most things, the numbers that you're going to remember is going to be 5 and 7. There is an additional one. It's 9/11. Now that's for more advanced, but just to keep in mind, 5 and 7 are typically what you would most commonly see. Now there are other ones that are usually less than 5. So 3, for example, is also one of them. So all the odd numbers, so 3, 5, and 7. But however, for the purpose of this class, I only need you to know 5 and 7. So 5 is usually any electronics. Okay, so for example, computers, telephones, registers, printers, right? They typically have a lifespan of 5 years. Now, in today's society, it's actually shorter than that. But you know, this is, I mean, if you bought a computer, let's say in 2015, it still works. It's just not doesn't work as fast as the 2020 ones, but it still works, right? It just works a little slower. For example, our classroom, right? We have 2002, that was it, Windows 2, I think we have Windows 7, if I'm not mistaken. However, we upgraded to Windows 10, which is more faster. But however, Windows 7 came out when? And it still works, okay? So that's just an example. So anything that's electronic, so again, computer, phones, printers, anything like that, typically they would have a 5 years in a Blue Kelly book. Okay, in Gap's Blue Kelly book. Okay, and anything such as furniture, machines, trucks, anything that has more of a useful life to it would typically have 7 years as their life. Okay, so again, I can't give you the specifics on where to find this book, but I'm pretty sure you'd be able to find it on irs.com because, again, they would have all the platforms and exactly what you can categorize as your useful life for fixed assets. Now, another thing that you can also determine as well is that if you actually, for example, purchase a printer, you read that box and it will tell you exactly how long this asset is supposed to last you. So if you actually did not know, by law, it is a requirement to put in the description on how often or how the longevity of the asset can be worth. And I believe it says on the box that printers usually are 5 years. Okay, wear and tear 5 years. It should give out after 5 years. Okay, so make sure that if you ever buy something new, look at the product description. They might tell you the useful life on there. Okay, yeah, interesting fact, right?
Yes.
So so you'd be able to find it out there. Okay, and I'll go ahead and talk about salvage value. So what salvage value is at the end of at the end of its useful life, it still retains some kind of value to the asset. As in, like, for example, okay, I bought my iPhone 8, right? Even though it's marketed to last only 5 years, I can still sell at the end of its 5 years, right? iPhone 8, it still got the great technology, it's still got the memory, it's still useful, except it has a residual value of at least $100. I could still go to eBay and sell it for at least $100. Okay, so that is what a residual value is. After its life has been done, its cycle has been done, it still holds a value in regards to selling purposes. But for GAAP, we say no. If you're going to use GAAP and you follow this rule here and you say GAAP is going to determine your salvage value, then you need to make sure that you zero it out completely 100, as in there is no residual value. Okay, so anybody that's not a sole proprietor must follow the rules of GAAP, and this is why I'm telling you this now, because if you plan to be a partnership or an LLC, you're going to have to follow the guidelines of GAAP 100%. Okay. But if you decided to determine yourself as a sole proprietor, again, you get some leniency on the useful life as well as the salvage value. So what sole proprietors can do is they get to make their own estimate of useful life. Now, of course, if it's a printer, right? Depending on how often I use my printer, I can might as well say this printer is going to last me 20 years. No, you can't just make that assumption. What you need to do is you actually need to do the research. Okay, you need to research your product. Okay, so if I researched my iPhone 8, right? If I researched it and I say, you know what? Because I don't use it so much, I only use it for making phone calls. I don't use it to play video games, or I don't take too many pictures, right? I don't utilize my phone as often as I should. Then I can make an assumption that yes, my phone should last me at least 10 years. And for those who have iPhones, I can tell you today, the iPhone 4 still works like a charm. It still works. Okay? It still works. And it's what, 10 years later now? And right now we're in 2020 and we have the latest iPhone, which is the iPhone 11. Yes, it's not going to work as fast. Yes, the internet is not fast. There are a few things that you can't download that's compatible for the iPhone 4. But it still works. It still can call. It still can take pictures. Not really good ones, but it still can take pictures. It can still do its functions. So if I was a sole proprietor and I use the iPhone 4, right? I can use that just like as a ticketing. If I know that I don't use it, then I can say, yes, this item will last me 10 years. So for example, I have a printer. I don't use it as often. All I need to usually use it for is to, change the cartridges, and it's fine. It doesn't give out on me, and I don't print as often. So therefore, I can determine with my research, and I know that this is the latest model, whatever it is, I can say that this printer will last me 10 years. Okay? So again, it's based upon your research, how often you use it, and what does it serve as part of your business. Okay? Second of all, salvage value you get to determine. Now, I'm not gonna say, oh my gosh, my iPhone, I'm not, 10 years later, if I'm still using the iPhone 8 and the iPhone 11 is out right now, I can't say that it's been used for what, 3 years now? That it's still got a couple years. I can't say in 10 years that I can still sell it for $400. No, it's not worth $400 at that point. It still holds a value. However, realistically, no one's going to buy it for $400, right? So you have to make some kind of salvage value that is determinable and that's actually reasonable. Okay, so in my sense, I say that my iPhone 8 as of today, after it's been 3 years, it's still got some residual value, at least $150. Okay, it's still in good condition. I don't use it as often, and I could still sell it for at least $100, $150 at max. Okay, so that's me giving the salvage value, doing my research, and again, choosing a number that's actually, reasonable. Okay, so for example, if I buy my printer for $100, I can already assume by 10 years from now, it's not going to be worth anything. Realistically, no one's going to buy a printer off of you for like $20 if it's, 10 years out of technology, right? You could just literally go down to the store and buy yourself a printer for $50. Okay? With the newest technology. So again, salvage value is determined. Now, a great example will be a truck. If you're buying a $30,000 truck, and you're telling me it's got 7 years on it, and you're going to tell me I'm going to zero out to zero? Heck no. But for sole proprietors, they can say, well, you know what? I can determine my asset, right? I could say this truck is going to last me 10 years. And I could say, after I used it for 10 years, right, if there's not much mileage on it, I can safely say that this truck can easily sell for scrap metal, or someone can buy it for me easily for $5,000, right? So that is the great thing about being a sole proprietor. You get more power to you, but if you are not a sole proprietor, you're going to have to zero that out, no matter what. No salvage value, and you're given a set number. Okay. Any questions about estimated life or salvage value? Okay.
Not yet.
Okay. All right. Next thing is going to be date of when you put the asset into service. Okay. So yes. Okay. This is very important. Okay. Let me go ahead and go over the concept first, and then I'll explain after. Okay. So the rule is, if it's anywhere between the 1st and the 15th, you have to depreciate that month. If it falls on the 16th or the 30th of that month, you're going to depreciate it the next month. Okay? Now, this applies for any time that you make a purchase of an asset. So, for example, I just recently bought my printer in June of last year, right? And what happens is depreciation, right? When you're calculating depreciation, it's actually for the whole year, okay? So it's if you guys remember from our previous example, let me see what we were dealing with. We were dealing with chapter 10, which was for interest, correct? Interest is valued in years, right? You need to convert it. Same thing here, okay? Depreciation, when we calculate depreciation, it's going to be for the entire year. So if I if I bought my printer in June of 2019, would it make sense for me to just depreciate it for a whole year? That's a question, by the way. Would it make sense for me to depreciate an asset for one whole entire year?
If you got it on June 16th, you said?
No. Well, first let's understand the month. I bought it in June of last year.
Okay.
Okay? Would it make sense for me to depreciate, not as of today, as of December of that month okay, as of last year, right? Would it make sense for me to depreciate it for a whole year?
Yes. 'Cause it's a year old by now.
By now, but my key word was I'm not talking about now. I'm talking about,
When you purchase it.
yes,
when you put it in
if I put it in service. If I put it in service in June,
No.
why?
You depreciate it when you put it into service.
Egg-
You buy it in February, not put it in service until May.
Exactly.
And, it doesn't get used until May.
Exactly.
It doesn't start life cycles.
Exactly. Good job, David. So, yes. How does this work? We're so confused right now. When we talk about assets, right? When we talk about the useful life of it, okay? Think of an asset as if it was a baby. Okay? What do I mean by that? When do you calculate your baby's first year?
following birthday.
The following day. Exactly. That's considered one whole year, right? Same thing with assets. The minute you depreciate it will be the minute you put it into service. So if I put my printer, right, I used it in June, right? In the beginning of June, I'm going to say I used it June 12th. That means I have to calculate, so by December of 2019, how old is my asset? If I bought it and I used it June 12th of 2019, and right now I want to calculate how old it is in December of 2019. How old is it? Okay, I'm going to ask that question again. If I bought my asset and I used it, as in I put into service on June 12th, and I want to calculate depreciation in December of 2019. So that same year I bought my printer. How old is my printer?
Right?
5 months, right?
Count again.
You put it into service June 12th,
Uh-huh.
Yeah.
and you wanted to depreciate it in December of the same year?
December 31st to be the most
31st,
accurate.
okay,
Okay?
of the same year.
Of the same year. Yes.
Be 6 months.
It'd be 6 months. That's correct. So that is the same thing you need to do here. So our assumption is that when we depreciate it, we're depreciating it from January 1st all the way to December 31st. Okay? All right? And yes, this is how we're going to calculate it. We're going to because usually depreciation, you don't normally depreciate every month or every you normally would do it at the end of the year. But for this scenario, I would like for you to understand how depreciation works. Whether it's given in months, whether it's given in quarters, in any given point of time. But just understanding that when you buy an asset and when you put into service, the day that you put into service is going to mark its first day. So again, if I put my asset in June, if I talk about today and I'm depreciating it today, for some reason I decided to choose today to depreciate it. How old is my printer? If I bought it last year at June 12th.
Um, a year and
Yes. Nope. Just 1
no,
year.
a year.
Just 1 year. So understanding that assets, when they're given an estimated life, they're just like babies. They're just like humans, right? We understand that their life begins the day that you start their life, which is when you put them in service. Okay?
Yes.
So understanding that if I were to calculate depreciation at the end of the year, it's 6 months old. If I were to depreciate it now, as of June, what's today? June 22nd? As of June 22nd, how old is my asset? It's 1 year now. My printer's 1 year now because today is June 22nd and I've already passed my June 12th mark, which is 1 whole year. Okay?
Okay.
So, yes, and this is very nifty too, okay? If I were to put my asset into service on June 20th, I need to depreciate it the following month because we want to make sure that if we're calculating our depreciation, we want to make sure that is it enough? Has it been used enough to calculate depreciation for the month? So for this example, if I did it in the beginning of the month, then yes, I for surely got 2 weeks out of it. But if I were to do it towards the end of the month, right? Let's say I put it on the 28th even. If I put it on the 28th, is it fair to me that I need to depreciate that extra month?
No,
I only used it for 2 days.
right.
So that the assumption here is if you were to put it into service after the 16th or 16th all the way to 30th, so after the 15th, you need to calculate it for the month after.
For the month, so you would calculate that at July 1.
Exactly.
Okay.
Yes. Good. All right. Cool beans. All right, everyone understand this? Okay. All right. All right, and then lastly, we're going to go over the different depreciation methods. So here we have a list of 6 of them, and I am only going to show you 3. Now, because the other 3, they're more advanced calculations, but back in my day, I was taught some of the years, and I was taught group and corporate methods because I was dealing with corporate level financial accounting, not private or not sole proprietors. But for sole proprietors' sake, you do need to know these 3. So activity-based method, okay, which is also known as units of production, straight line, and you need to know we call in corporate we call it accelerated. In private, it's also known as double declining. Okay? So these 3 are the 3 methods that I'm going to be talking about, and they are very useful because most commonly you're going to see oftentimes will be straight line and the double declining. Okay? But then again, those are the 2 most common ones to use. Okay?
Okay.
But today I'm going to focus on units of production. Okay? So what is units of production? Units of production is going to be, you're going to depreciate based on the number of units an asset can produce. Okay? So this one, right? For example, a printer can print out 100,000 pages, right? If a printer can print out 100,000 pages, by the time it reaches towards that end of it, it gives out. That means it can't print anymore, right? So the formulas that you're going to be focusing on will be depreciation basis, okay? Which is going to be your cost of the asset minus your salvage value, okay? So that's your depreciation basis, okay? If you guys need some time to write this down, please do so. So depreciation basis is going to equal your cost of asset minus your salvage value, okay? Second formula you're going to be looking at is called per unit rate, okay? Your per unit rate is going to be your depreciation basis divided by the total estimated number of units produced, okay? Okay? So that means every time you're given a problem, it's going to give you, for example, my printer can last 5 years and it's going to be, it could produce 100,000 pages, right? So that's what this number is. The 100,000 units produced is going to be the number of, the total estimated number of units produced. Okay? Depreciation expense is going to be your number of units produced that year multiplied by the rate. Okay, so you're going to be given another column of units that were produced that year. Okay, and then accumulated depreciation is going to be your previous year's depreciation. Ignore the word expense. Depreciation plus your current year's depreciation expense. Okay? So again, you're going to have your accumulated depreciation and you're going to have your depreciation expense, right? And then lastly, the last column that we're going to be introducing is what a book value of the asset, which is your cost of the asset minus your accumulated depreciation. Now, all of these formulas will make sense when we apply them. Okay? So let's go ahead and dive into the example. So example number 1 tells you that you need to record the depreciation for the first year's for the first year. Okay, there was 2,100 units produced for the first year. Now let's see what this asset is. This asset is a machine. It cost you in total $15,000. Its salvage value is $2,500. Its useful life is 5 years. Its number of units produced is 10,000. And the date that it was put into service is January 1st. Okay? So, the first formula that you're going to recognize is, yes?
I didn't know if you recorded or not. I didn't see the button.
What button?
I didn't know if you hit the button to record or not.
Yeah. You want me to double check right now?
Oh, I don't know.
I'm pretty sure I did.
Okay.
Yes, it is recording.
Good.
Okay.
All right.
I saw the countdown.
Okay.
Yeah.
Sure. Do you have all 5 components? Okay. So the first component was, do you have the asset cost? The cost of the asset. Yes, you do. It's
Yeah.
15,000.
Okay.
Okay. Your second thing is, do you have an estimated useful life or units produced?
Yes.
Yes, you do.
Yes.
You have a units produced here for 10,000, and you even have the estimated useful life of 5 years. Third thing is, do you have a salvage value?
Yes.
Yes, it's 2,500. Fourth thing is, do you have a date of when you put it into service? Yes, it's for January 1st. And then lastly, do you know what depreciation method you are using?
Yes. Units of production.
Perfect. Then you have all 5 components, and you're able to move on with this equation. Move on with this problem. So the first thing we're going to do is we're going to explore the first section. So first of all, we need to solve for the depreciation basis. So here we know what the information is. So how do we solve for the depreciation basis?
Minus this the unit price minus the salvage value
Not unit price.
or
No, the
production.
cost of asset,
Cost of asset.
15,000 minus the salvage value, which is 2,500, should give you 12,500
That is correct.
as the cost of asset.
Could
Perfect.
you go back over that again?
So what?
Could you say that again? My pen sort of, messed up when I was.
It's
following along.
it's on the screen.
Oh, I see,
Yeah.
okay, gotcha.
So you're gonna take your cost of asset, which is $15,000. You're gonna minus the salvage value, which is 2,500, which gives you a total of 12,500. Okay. All right. Good. Now the next thing you're gonna solve for is going to be the per unit rate. And what is that formula?
Description rate divided by
The depreciation basis, which we came up as 12,500.
Correct.
Divided by, divided total estimate units, which is what, 10,000?
That's correct.
Okay, so 12,500 divided by 10,000,
Mm-hmm.
calculator, is 12,500 divided by 10,000. Okay, I have 1.25.
Okay. And that is correct. It's going to cost you $1.25 for every item this machine produces. Okay. All right. So the next thing is we're going to solve for the depreciation expense. So what is the depreciation expense? What's the formula for that?
number of units times the rate.
Okay. So what numbers are you going to be using?
So 10,000 times 1.25.
Okay. Not 10,000. Let's look at the equation again. Number of units produced that year.
Yes.
So let's look at the column over here. Number units produced, right? For year one, how many did it produce?
2,100.
2,100 is correct. So for this 1 year, the first year, you've produced a total of 2,100 that year. If you look at the problem before that, it says that right here in the description that you produced 2,100 that year. So now how do I calculate my actual cost? Or my actual depreciation expense?
Okay, so we take that, the 21 of $1.25.
Mm-hmm.
Right?
Mm-hmm.
Okay.
1680.
No, but I told
26.25.
yeah, 2625 is correct. All right. All right. Okay. So now we got to figure out, well, what is accumulated depreciation? Accumulated depreciation is going to be your previous year's your year I'm so sorry. Your previous year's depreciation expense, which is wrong. That's supposed to be accumulated depreciation. Plus your current year's depreciation expense. So in this case, did we have anything to begin with?
No.
No. However, we have this year's depreciation expense, which is what?
26.
25.
2625. So therefore, you're going to add 0 plus 2625, and you're going to get 2625.
26.
Okay? How do you solve for book value? What is the formula for book value?
The
Okay,
cost of the
cost of
asset.
asset minus accumulated depreciation, so 15,000
Correct.
minus 2625.
Correct. And we should get a total of 12,375. Okay? So that means by the end of year 1, your asset is worth now 12,375. Okay? It's no longer worth 15,000 because you already used the asset. It's not worth it anymore for $15,000. Okay? All right? So again, this section is very, very easy as long as you understand what the formula is at hand. And again, I am going to be giving you the formulas for the test. So you don't need to memorize this. All you need to know is what goes where. Okay? So let's go ahead and solve for the second year. All right? If the second year I went ahead and the second year I produced a total of 2,000 units. Okay? A total of 2,000 units that year. How do I solve for the rest of this table?
Okay, depreciation is the cost of
Uh-huh.
asset salvage value. So, we still use 15,000
Correct.
as the cost of asset
Good.
minus, the salvage value is still 2,500.
Mm-hmm.
Right, so it's still the same as before, 12,500.
Correct. Okay.
Okay, so under depreciation, we should put down 12,500.
Correct. The next slide, I have all the answers up, so I just have to wait till you finish all the answers before I can post it up.
Oh,
Yeah, sorry about that.
okay. Sorry. I've been waiting for you to like post on, so, okay, so now we gotta come up with the rate. Should be the same.
Yes, it should be the
since
same.
previous numbers are the same.
Yes. Good. All right.
So then.
What is the depreciation base?
1.25 depreciation.
Expense.
Expense. Number of that year.
Mhm.
Okay, that's different because we only produced 2.
Correct.
And, okay, so times the rate. So times 1.25.
Mm-hmm.
I want a new calculator. No, my iPhone, I've been using that for my calculator.
That's 100% okay.
I got
Oh,
that
okay.
touch. Well, I gotta use the touch. To, it keeps going off. I have to re-enter my code to access it.
Yeah.
Oh no. Okay.
Thing. It's just an extra step I have to do.
No worries.
I got 2,500.
Correct.
Oh, okay, we move. Let's see. Now we're at depreciation. So we do have a previous year's accumulated depreciation.
Yes, we do.
It was 2625.
Correct.
So we add 2625 plus our
New one.
Well, yeah. Well, what was our new one?
2,500.
Yeah, 25.
2,500 plus 2,625.
Mm-hmm.
That would be 5,125.
Correct. And then
Yes.
what is your book value now?
So we subtract 5,120 from the previous year's book value of 12,375.
No. I didn't. No. Start again. Look at the equation. What does the equation say?
Oh, yeah. Cost of asset,
Mhm.
which is 15,000
Correct.
Minus
minus the
5125.
depreciation.
Okay. I'm sorry. I'm hearing this like really loud noise. I can't tell if it's a fan that's blowing into the computer. Thank you.
It sounds like wind.
Yes.
It sounds
Yeah.
like
Are you
wind.
guys going outside?
Yeah, it does.
no,
Not here.
Okay. So were you able to calculate it, Lee?
9,875.
Let's see. Okay. Boom. So again, you got the first
Yay.
ones correct, and this one's actually not 5,000. It's 9,000. Oh, unless you said 9,875.
she just
Okay. Okay. I heard 5,000, but that's okay. Yes. Yes. So you did it correctly. Yes. And few things that you need to notice is you're going to notice. Okay. So I'm gonna go ahead and solve for the rest of the problem. You're gonna notice that this. Okay. You're gonna notice that here. Let's focus on one column at a time. So you're gonna notice that your number of produced that year should equal up to $10,000. I have 10,000 units. Okay. Then you're also gonna realize that your depreciation basis and your depreciation rate, they're the same. You solve for one, you have all of them. Okay. So you don't need to actually calculate this part once you've done one. You need to know that that it's going to stay constant for the rest of the problem. Okay? The only number that's actually going to change is again how you calculate your depreciation expense. So again, you're keeping the $1.25, but you're multiplying it by the depreciation. I'm sorry, the number of units produced that year. So every time you're multiplying it by the per unit rate, you're gonna get a different number every single time. All right, and what you're gonna notice that at the end, when you calculated everything, your accumulated depreciation at the end of the 5th year should equal your depreciation basis. Okay, that's one point of reference that you did it right. Okay, at the end of the 5th year, your accumulated depreciation should match your depreciation base. Okay, and then here's your second point of reference that at the end of the day, at the end of the 5th year, your book value should equal to 2,500, which is your salvage value. Okay, so that means at the end of the year, you said that it's supposed to be worth 2,500. There you go. It is worth 2,500. Okay.
okay.
All right. See again, easy peasy if you just know what to plug in. Okay, it's straightforward. Okay. Is someone walking again?
Yeah, I hear it again.
Yeah, well, I'm at my desk like normal.
Yeah.
Okay. David, you're not outside or anything?
No, ma'am.
All right.
David, where's your fan? Where's your fan? Last week you had it right by your computer. Where's your fan today?
I turned it off.
Okay, so okay. That eliminates.
I turned it off before we even started.
Okay, perfect. Okay.
Oh, okay.
Just making
Nice.
sure. I can't see who it is, but I will be able to see it once I log out of this or once I get out of this. So we're good.
Oh, okay.
So good. So for this example, yes, good. That's what happens. I'm just going to continue and then we'll take a break and then do the example afterwards, okay? So, good. Now, all I need you to understand is when we're looking at this, once you solve for one, for the depreciation basis and the depreciation rate, they all stay the same. So you don't need to do the extra step anymore, okay? All you need to do is calculate the depreciation expense because every year it's going to be different, okay? Depending on how many units you produce. And then lastly, the accumulated depreciation should match your depreciation basis and your book value should match your salvage value, okay? Now what happens if I decided to go beyond the 5 years, right? Or on year 5, the machine produced a total of 200 units. What happens if I were to do that? Okay, so if you can go ahead and,
To recalculate.
yes, you have to recalculate it. Go ahead and recalculate it. So this time, so if we look in the previous one, we increased it by 200. So what happens if I produce 2,200 units that year? What happens? Can someone calculate the rest? So we already know the depreciation basis and the rate's going to be the same. However, what is the rate? What is the depreciation expense for that year?
Shoot, I don't have the formula for that.
Okay, so again, I'll tell you the depreciation expense is going to be your per unit rate multiplied by the units produced that year.
Oh, okay, so,
Per unit, could you repeat that? I'm
The
sorry.
depreciation expense is going to be your per unit rate multiplied by the number of units produced that year.
27.
okay, so 2,200 times 1.25.
Mm-hmm.
Okay.
2750.
Yes, I got 2750. Anybody else?
Me
Yes.
too.
2750. Okay, good. So what is the cumulative depreciation for that year? So if I take 10,000, right? Right? It's going to be the previous year's accumulated depreciation plus your current year's depreciation expense. So if I take 10,000 and I add 2750, what do I get?
12,750.
Yeah, 12,750 is correct. All right. And then if I were to calculate my book value, what is my book value?
Divide that by the original cost.
Not divide. You're gonna take your original asset cost and you're gonna minus. Yes.
I did that wrong.
So 2,250.
2250 is correct. Now, one thing that you can't do is, okay, you can never, ever, ever depreciate beyond the produced amount. Okay. Yes, in realistic, yes, you could say, oh yeah, it produced me 22 more items, but think of this as a capacity, right? Your capacity is only 10,000. Okay? If you are given that capacity and you say you produce 2,100, that's fine. But once you reach capacity, you stop there. Okay? So you would still calculate this asset as if it produced 2,000 items that year. Okay? Because you can't, one other key factor too is you can't go beyond your salvage value. Okay? If your salvage value is 2,500, you cannot go beyond that. Okay? Same thing with your units production. You can't go beyond the limit of 10,000. So you would only calculate it up to how much it is to the capacity, which is 10,000. Okay?
Okay.
So that is that one. Okay?
Let's add another year by doing the same thing.
No, you can't do that. Once your assets reach capacity, that's it. So if it did produce an extra 100, you're not going to cost it at all. You're just going to leave it at 0. Okay? That is the rules of GAAP. There's no explanation to it, but it is true because this is assuming that you made this estimate because you have a salvage value, right? So which entity is allowed to create the estimated useful life and estimated salvage value?
The The sole proprietorship.
Yes. So that means you may have overestimated or underestimated. So in this case, we underestimated. We guessed that this machine can produce 10,000, but in reality, it produced 200 more than what it could go. So yes. So another thing that I also want to point out is that if you noticed, it doesn't matter what the life of this asset is. It doesn't matter how long you have this or the estimated life of it. It doesn't matter. This can go overflow to 6 years. It could overflow to 7 years, right? What matters is it's based on what? It's based on the number of units produced. Okay? So for example, if I wanted to, or let's just say I did, my capacity is 10,000, right? Let's say, for example,
Yes.
year 2, I produced 17,000. Year 3, I produced 18,000. Year 4, I produced 1,000. If I produce less and less every year, right? And I notice that my machine is lasting me more than 7 years,
Uh-huh.
it doesn't matter how old the asset is. The only thing that matters is what the capacity is. So this asset does not reflect, it's not based on its life. It's based on how much it can produce. Okay? So understand that's one significant difference, okay? So it doesn't matter when you start it. Yeah, it doesn't matter when you start it either, because it's irrelevant, right? It doesn't matter how old the asset is. It doesn't matter when you start it. It matters on the total number of units produced. So that date that I gave you, January 1st, that doesn't matter. Okay?
Okay.
The only thing that matters is how much can it produce. What is the capacity that this machine can do? So yes, it can go beyond the years of life of it, and it can definitely. It doesn't matter when you start it, as long as you have a current years that it produced. Okay. So now we're going to be looking at how to journalize depreciation. So, okay, at the end of the first year, record the journal entry for the depreciation for the first year for the machine. Okay, so here we have the table at the bottom. First year we had 21 units, okay? And we know that our depreciation expense is going to be 2625. Now in this case, I forgot to give you a little introduction of how to journalize this, but how you're going to journalize it is you're going to be looking at two accounts. You're going to be looking at depreciation expense, and you're going to be looking at accumulated depreciation. Okay, those are the two key journals that you're going to have. Okay,
Okay.
you are not going to write this off directly from the asset. Okay, again, you are not going to write off this directly from the asset. Okay? If you do, boom, right there, you already breached rule number 1, was historical cost. Are you allowed to change the value of your historical cost? No.
No.
So this is exactly why we cannot, when we depreciate this asset, we cannot change the value of the asset. We can only do it when we sell the asset, okay? And in this case, if I were to sell my asset as of right now, I already know that I cannot sell it for more than $15,000. I can't sell it for more than 12,375 because it's not worth that much. Okay? It's already lost a quarter of its life. Or I'm sorry, what's 1/5? It already lost 20% of its life. Okay? By producing 2,100 units. Okay? So the thing that you're going to be recognizing is depreciation expense, and you're going to be having an accumulated depreciation account. Okay? Now, what accumulated depreciation is? Accumulated depreciation is a contra account. Okay? It just lets you know how much your asset is worth as of today. Okay? But due to historical cost, when you sell it, you need to sell it for what the price that you listed it as when you purchased it the first day. Depreciation expense is going to be an adjusting entry. Okay, so again, let's look at this again. So depreciation expense is going to be an adjustment entry, while accumulated depreciation is going to be your contra account. Okay, and it's going to be for the first year, it's going to be 2625. Okay, so let's look at our table again. Where are we getting these numbers from? It's pretty straightforward. We got depreciation expense and we have accumulated depreciation right here. However, in our books, when we're calculating, doing our depreciation tables, accumulated depreciation is going to include the previous year's accumulated depreciation plus the current year, okay? But in this case, when we journalize it, we want to make sure that we journalize it for the equal amount. And then when we look into our ledger, that's where accumulated depreciation should increase every year you do your depreciation expense. Okay? All right. Okay. So now the question is asking you how to record, to journalize the entry for the depreciation for the machine for the second year. Okay, so what are the journal entries you need to have?
Depreciation.
Uh-huh.
And
5,001, right? I mean, 2,500.
Yes.
Yes.
Yes, 2500 is correct. Okay, because we're talking about this year, which is the second year. We're not talking about anything that happened in the past. Okay? And again, when we look into our general ledger, your new accumulated depreciation should be 5100. Okay? Because we're going to be adding this to the account. All right?
Okay.
All right. So now let's look into scenario 2. Okay, scenario 2 is going to ask you, well, what happens when I put the service, this asset into service on October 18? Okay, so on October 1st, a machine was purchased for $10,000, and its useful life is 5 years, and a capacity of 25,000 units. Okay, it has a salvage value of 2,500, and at the end of its life, okay, the machine was put into service on October 18. Record the depreciation for the first year when total units produced was 250. Okay. So, do we have all 5 components?
Yes.
Yes, we do.
Yes.
We have the asset cost, we have a salvage value, we have a date put in service, we have a useful life slash number of units produced, and we also have the date in service. Okay. Now here I put in blue is October 18 means that no depreciation expense for the month of October. Okay. So what does that mean? You need to do what? So only so
November, December.
so you need to
Just,
go ahead.
no, it's okay. I think there's a delay between you talk and all that, so I don't hear that you're talking until I started talking.
Oh.
I'll just shut up. Make sure that you're done.
All right. All right.
I'll wait completely till you're done.
Okay. All right. So this one is saying here that you only need to record the depreciation for the month of November and December, right? What is, if we did October 18, what's the numbers? What's the numbers that determine why you need to depreciate November and December?
Well, it would be 0
Okay.
for depreciation Yes, because there is none.
Okay, but what was there? What was that? I forgot what it's called. When we learn about depreciation, I'm sorry. When we learn about putting dates into service, if it falls between what?
Mhm.
What does it fall in between?
The first and
After
15th
June,
Yeah, first and
so
15th, so that
calculate
would,
for
after
the
the
next
16th
that would
to
be
year.
the
for
30th.
November.
Too many people said things, but all I heard was yes, David, you are right. It is it because if it falls between the 1st or the 15th, then you need to depreciate that month. In this case, it fell after the 15th, which is from the 16th to the 30th, so you have to depreciate the month after. Okay? So in this case, October 18th, that means you went beyond the 15th. So therefore, you don't need to depreciate October, you need to depreciate the month after. So November and December. Okay?
Okay.
Okay.
All right. So go ahead. Let's solve this. Okay?
Awesome.
How do I solve this? If I only produce 250 units that year, okay, which is what, November and December. How do I calculate this? What's the depreciation basis?
Cost of the asset is 10,000.
Mm-hmm.
Oops. Minus
2,500.
salvage is 25. What is wrong with my calculator?
Okay, 10,000 minus 2,500 is 7,500.
Correct.
That is our,
Depreciation
um,
basis. All
right.
right. So what is the per unit rate?
Depreciation base is 7,500 divided by, what do I estimate? So 250?
Not 250. That's what's produced that year.
Right, it says total estimated number of
Mm-hmm.
units. Okay, the production life,
Mm-hmm.
so 10,000.
Not 10,000. That's the
Oh, no,
cost.
oh my God, I'm not saying thousand.
Yeah, 25,000.
25,000, oh, 3.
So
I have the rate as 0.3.
perfect. So 30 cents if you change it into cents.
Right, okay, 30 cents, yes.
Okay. So if I produce only 250 between the month of October 18th all the way to December 31st, right? That's only 2 months, right? How much is my depreciation expense?
Okay, so 250 times 30,
30 cents. Uh-huh.
I get $75.
What do I,
Yes.
that's what I got.
Perfect. $75 is perfect. And what is the accumulated depreciation? I don't have that answer, but here, let's go ahead and solve for that. So what is your depreciation expense, your accumulated depreciation?
Okay, what's the,
The
okay, we
previous,
don't have a previous,
yeah,
Yeah,
so that's a zero, 75,000, I mean $75.
yep, so $75 is correct. And what is your book value now?
Okay,
Your book value is going to be your total cost minus your accumulated depreciation. Total cost of asset.
Okay, so 10,000 minus 75.
Mm-hmm.
Okay. Okay, 9,925.
That's correct. I don't know if I have the answer for that one, but okay. So it's supposed to be filled in, but yes. So do you understand what happened here? So does it even matter if we even have a time for this? No, because time is not relative. Time is not sensitive when you're dealing with depreciation for units of production. All we care about is how much items we produced that year. Okay, so again, understanding that, I already solved it for you, but understanding that you only have 2,500 units produced at time, our depreciation expense is $75. So our journal here is going to be depreciation expense for $75 with a cumulative depreciation of $75. And if we notice here, we don't care about time. Time, again, is not sensitive to this. We don't care about the time because it doesn't matter when you start as long as you have the number of units produced that year is all you care about. All right? Chapter review. Again, we learned about what depreciation is. Okay? Again, when we look into straight line, I'll go ahead and go over what amortization is. But then again, 5 components of depreciation is your cost of asset, estimated life, salvage value, date in service, and again, your depreciation method. Okay? Other things that you need to know is no matter when you are journalizing for your depreciation, it will always be depreciation expense, and then your credit will always be accumulated depreciation. And if you're being specific, you definitely want to be specific on the asset. So it'd be depreciation expense for whatever asset it is, or it could be accumulated depreciation for whatever asset it is. Okay? Few things that you need to know, okay, that when you're dealing with partial years is that if you calculate it from the 1st to the 15th, you need to depreciate it that month. If it's any time after the 15th, which is 16th to 30th, or 31st, I don't know why I don't have a 31st there, depreciate the month after, okay? Few rules here. GAAP determines whether you have 5 years, 7 years, and no salvage value. For management, under sole proprietorship, you get to determine the life and you get to determine the salvage value. And then lastly, units of production. Here is the entire formula waiting for you. Again, I have this in a review session, review sheet for you. So you don't need to memorize this. All of this will be given to you. Okay? And then lastly, understand that units of production, it's not even based on time. Again, it's based on the capacity. All right? Okay. So right now it is 3 o'clock. And we'll go ahead and resume with